If you're considering whole life insurance, you've probably heard two completely different opinions. One person may say it's one of the best long-term financial tools available, and someone else may say it's expensive, complicated, and something you should avoid. So who's right? Well, the honest answer is it depends. It depends on the policy, how it's structured, and most of all, on why you're buying it in the first place. I've seen whole life insurance become a valuable long-term asset for a family. But I've also seen people buy policies that didn't match their goals and left them frustrated years later. So, in this video, I'm going to walk you through what whole life insurance is, how it works, what to review before buying it, and how to figure out whether it fits within your broader financial plan. Because buying whole life insurance can be a mistake if you buy it for the wrong reason. And if you'd like help reviewing a whole life policy, an illustration you received, or your overall financial plan, I've included a link in the description where you can schedule a free call. Together, we'll look at your goals, your current strategy, and whether this type of policy can fit the role you need it to play. Okay, to begin, let's answer the question, what is whole life insurance? Whole life insurance is a type of permanent life insurance. Unlike term life insurance, which covers you for a set period of time, whole life is designed to remain in force for your lifetime as long as the required premiums are paid and the policy stays properly funded. A whole life policy generally has two main parts. There's the death benefit, which can be paid to your beneficiaries, and there's the cash value, which can grow over time inside the policy. That cash value may be accessible through loans or withdrawals, depending on the policy and how it's structured. But before getting too focused on cash value, it's worth remembering something. Whole life insurance is still life insurance. It's not an investment account. It's a contract with an insurance company. That means the guarantees, costs, premiums, cash value, dividends, and long-term projections all need to be reviewed carefully. And that brings us to the next question. What need are you trying to address? Before reviewing any illustration, ask yourself why you're considering whole life insurance in the first place. Are you looking for permanent life insurance protection? Do you want to leave money to children, grandchildren, or a spouse? Are you trying to create liquidity for estate planning? Do you own a business and need succession planning? Are you interested in tax advantage cash value growth? Or are you looking for another financial tool outside of traditional market-based investments? All of these are very different goals, and whole life insurance may fit some of them better than others. This is where people often get into trouble. They start with the product and then they try to make their goals fit around it. But the planning conversation should come first. Start with the need you're trying to address. Then decide whether whole life insurance is the right tool to help address that need. Because a policy that makes sense for estate planning may not be designed the same way as a policy focused on cash value accumulation. A policy designed for death benefit protection may not look the same as one designed for long-term flexibility. And if the design doesn't match the goal, disappointment can show up years later. The insurance company behind the policy. Whole life insurance is usually a long-term commitment, and in some cases, it may be part of your financial life for decades. So, you're not only evaluating the policy, you're also evaluating the company behind it. That means looking at the insurer's financial strength, history, and ability to meet long-term obligations. You may also want to review ratings from organizations such as AM Best, Moody's, Standard & Poor's, or Fitch. Those ratings aren't guarantees of future performance, but they can provide useful context when evaluating the company's financial strength. This is especially relevant with whole life insurance because many of the policy's benefits are intended to extend years or decades into the future. So don't only ask, what does the illustration show? Also ask, who is standing behind this contract? Participating policies and dividends. One feature people often hear about with whole life insurance is dividends. Some whole life policies are participating policies, which means they may be eligible to receive dividends. But dividends aren't guaranteed. That's one of the first things to understand. But if dividends are paid, they may be used in a few different ways. They may be used to purchase additional paid-up insurance. They may reduce premiums. They may accumulate with interest. Or they may be taken as cash, depending on the policy. This can affect how the policy performs over time, but again, dividends are not promises. So, if a policy illustration shows dividends playing a major role in future cash value or death benefit growth, you need to understand the assumptions being used. What happens if dividends are lower than projected? What happens if the dividend scale changes? What part of the illustration is guaranteed? And what part is not guaranteed? Those are questions worth asking before you buy. How to read the illustration. Most people look at a whole life illustration and focus on the projected values. And that's understandable because the numbers are often the first thing that gets your attention. But the projection is only part of the story. An illustration is not a promise. It's a projection based on assumptions. So, when reviewing an illustration, you want to separate what is guaranteed from what is not guaranteed. You want to understand how premiums are being paid, when cash value starts to build, what the surrender value looks like in the early years, how dividends are being illustrated, and what happens if the policy performs below expectations. This is especially true if the policy is being presented as a cash value strategy, because in the early years, cash value may be lower than the premiums paid. That doesn't automatically mean the policy is bad, it just means you need to understand the timeline. Whole life insurance is generally designed as a long-term strategy. If someone expects quick access, short-term returns, or immediate flexibility, they may be disappointed. So, before buying, ask yourself these 3 questions. How long do I expect to keep this policy? Can I commit to the premiums? Does the policy design match the timeline I actually have? The premium commitment. Whole life insurance usually requires ongoing premium payments. That commitment needs to fit comfortably inside your financial plan. Not just this year, but years from now. Through market changes, income changes, retirement, and unexpected expenses. A policy should support your broader plan. It shouldn't become a financial burden. That's another reason policy design is so relevant. Not all whole life policies are designed the same way. Some prioritize a larger death benefit. Others are designed to build cash value more efficiently. Some are used primarily for estate planning or business planning. Even though they're all called whole life insurance, the way they are structured can lead to very different outcomes. So, before buying, you want to know how the policy is being funded, what the premium commitment looks like, and whether that commitment still makes sense if life changes. And if you've been shown an illustration and aren't sure how to evaluate it, there's a link in the description where you can schedule a free call. We can review the policy design, the assumptions, and how it may fit with your overall goals. Now, let's talk about accessing cash value. One reason people consider whole life insurance is the ability to build cash value over time. That cash value can potentially provide flexibility. But before buying, you need to understand how access actually works. Policy loans are not the same as withdrawals from a bank account. Loans may accrue interest. They may reduce the death benefit. They may affect long-term policy performance. And if a policy lapses with loans outstanding, there can be tax consequences. So, while cash value can be useful, it should be managed carefully. You don't want to buy a policy assuming the cash value will help address future needs without understanding how loans, interest, premiums, and policy performance interact. This is where realistic expectations are critical, because cash value can be a benefit, but it's not free money, and it's not separate from the rest of the contract. How whole life can fit into a retirement plan. Whole life insurance shouldn't be evaluated in isolation, especially for retirees and pre-retirees. You want to understand how it can fit with your investment accounts and Social Security strategy, as well as your retirement income plan, tax planning, estate goals, and liquidity needs. For some people, whole life insurance may play a role in legacy planning. For others, it may provide permanent insurance protection. For some business owners, it might support succession or buy-sell planning. And for others, it may not be the right fit at all. The main thing is to avoid treating whole life insurance as a one-size-fits-all solution. It's one tool. And like any tool, it should have a clear purpose. If the purpose is unclear, the decision can become confusing. So, before buying, ask, what role is this policy supposed to play? How does it interact with the rest of my plan? What am I giving up by putting money here instead of somewhere else? And what would need to happen for this policy to be considered successful years from now? The last question can reveal a lot because it forces you to define what success looks like before committing to the product. Opportunity cost. Every financial decision comes with trade-offs. The money you put into a whole life policy is money you're not using somewhere else. That doesn't make the decision right or wrong, but it does mean alternatives should be reviewed. Could that money be used to fund retirement accounts, pay down debt, build liquidity, invest elsewhere, support long-term care planning, strengthen an emergency fund, or meet another financial priority? The answer depends on your situation. But before buying whole life insurance, it's worth knowing what you're choosing and what you're choosing not to do. That way, the decision is made with open eyes, not just because an illustration looked attractive. Lastly, I want to talk about the biggest mistake to avoid. The biggest mistake you can make is buying whole life insurance before understanding the role it's supposed to play. For example, someone gets shown an illustration. The projected values look strong. The tax features sound appealing. The death benefit sounds useful. And they move forward without fully understanding the premium commitment, policy design, dividend assumptions, cash value timeline, or opportunity cost. Then years later, they wonder why the policy doesn't align with their expectations. That's why expectations need to be clear from the beginning. Whole life insurance is not magic. It's not a shortcut to wealth, and it's not a replacement for a comprehensive financial plan. But for the right person, with the right goals, the right design, and the right expectations, it may play a valuable role. So, before buying a policy, here are the questions to review. What need are you trying to address? Is the insurance company financially strong? Are dividends being shown as part of the projection? What is guaranteed and what is not? Can you comfortably commit to the premiums? How does cash value access work? How does the policy fit with the rest of your retirement plan? And what alternatives should be considered? Because the goal isn't simply to buy whole life insurance. The goal is to determine whether it belongs in your financial plan. So, if you're considering whole life insurance, already own a policy, or have an illustration you'd like reviewed, click the link in the description and schedule a free call now. Together, we'll review your goals, evaluate the policy or illustration, and help you understand whether whole life insurance may fit within your overall financial strategy. That way, you're not making a long-term decision based on a sales presentation. You're making it with a clearer understanding of the policy, the trade-offs, and the role it may or may not play in the future. Thanks for watching, and I'll see you in the next video.